The stock market might seem like a complex and intimidating place, but once you break it down, it's much easier to understand. It's essentially a place where people buy and sell ownership in companies in the form of stocks. Whether you're a seasoned investor or a newcomer trying to grasp the basics, the stock market offers opportunities for wealth creation, though it also comes with risks. In this guide, we'll explore the essentials of the stock market in a simplified manner. What is the stock market? At its core, the stock market is a platform for buying and selling shares of publicly traded companies. When you buy a stock, you're purchasing a small piece of ownership in that company. If the company does well, its stock price usually increases, which can make your investment more valuable. On the other hand, if the company performs poorly, its stock price may decrease, leading to a potential loss for the investor. There are two main types of markets. Primary market, this is where companies issue new shares to the public for the first time, often through an initial public offering, IPO. It's where the company raises capital directly from investors. Secondary market, once a company's shares are publicly traded, they are bought and sold among investors in the secondary market. This is what people usually refer to when they talk about the stock market. Stock exchanges. Stocks are traded on stock exchanges, which are regulated marketplaces where buyers and sellers meet. The two most famous stock exchanges are New York Stock Exchange, NYSE, founded in 1792. This is one of the oldest and largest stock exchanges in the world, listing many of the largest companies. Nasdaq, known for its focus on technology companies, the Nasdaq is an electronic exchange that operates without a physical trading floor. Other notable exchanges around the world include the Tokyo Stock Exchange, the London Stock Exchange, and the Shanghai Stock Exchange. How stock prices are determined. Stock prices are influenced by supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell than buy, the price goes down. Several factors can affect this dynamic. Company performance. If a company reports higher earnings than expected, its stock price is likely to rise. Economic factors, interest rates, inflation, and economic growth can all impact stock prices. Market sentiment, investor confidence or fear can drive prices up or down, sometimes regardless of a company's actual financial health. Why do companies issue stock? Companies issue stock to raise capital for various reasons, such as expanding operations, investing in new projects, or paying off debt. When a company goes public, it sells shares to investors in exchange for cash. The money raised from selling stock allows companies to grow without having to borrow money or rely solely on revenue from their business operations. Why do people buy stocks? Investors buy stocks for two primary reasons. Capital appreciation, this refers to the increase in the price of a stock over time. If you buy a stock at $50 and sell it at $100, you've made a profit of $50 per share. Dividends, some companies pay dividends to shareholders, which is a portion of their profits. Dividends provide regular income for investors, making certain stocks attractive for those seeking steady returns. Types of stocks. There are two main types of stocks. Common stock. Most people who invest in stocks buy common stock. It gives shareholders voting rights in the company and potential dividends, although dividends are not guaranteed. Preferred stock. Preferred shareholders don't usually have voting rights, but they receive dividends before common shareholders and have a higher claim on company assets if the company goes bankrupt. Risks and rewards. Investing in the stock market can be highly rewarding but also comes with risks. Here are some key things to consider. Market risk. Stock prices can fluctuate dramatically due to economic conditions, company performance, or external factors like political instability. Volatility. Stocks can experience rapid price changes in short periods, making them more volatile than other investment options like bonds or savings accounts. Diversification. To mitigate risk, investors often diversify their portfolios by owning a mix of stocks across different sectors or geographic regions. Investment strategies. There are various approaches to investing in the stock market. Some of the most common strategies include buy and hold. This strategy involves purchasing stocks and holding onto them for the long term, regardless of short-term market fluctuations. Day trading. Day traders buy and sell stocks within a single day, attempting to profit from short-term price movements. While it can be profitable, it's also very risky. Value investing. Investors like Warren Buffett follow this strategy, seeking stocks that are undervalued by the market but have strong fundamentals. Growth investing. This strategy focuses on companies with high growth potential, even if their current stock price seems expensive relative to their earnings. 9. How to start investing. Starting in the stock market doesn't require a fortune, but it does require knowledge and a plan. Here's how to get started. Open a brokerage account. You need a brokerage account to buy and sell stocks. Online platforms like Robinhood, eTrade, and TD Ameritrade offer user-friendly interfaces for beginners. Set investment goals. Determine your risk tolerance, how much you're willing to invest, and what you hope to achieve, whether it's long-term growth, income from dividends, or something else. Research and diversify. Never put all your money into one stock. Diversifying your investments across various sectors and asset classes can reduce risk. The stock market offers vast opportunities for wealth creation, but it requires careful consideration and research. Understanding the basics, what the stock market is, how stock prices are determined, and the different investment strategies available, is essential for making informed decisions. While risks are inherent, with patience and a clear strategy, the stock market can be a powerful tool for growing your financial future.